Good morning and welcome to the Killik & Co market update. We are moving through the fourth quarter reporting season now, so there is a bit more news flow and things are starting to get a bit busier. This week we've been looking at something called the Phillips curve, which is an economic model that's quite heavily relied upon by central bankers when they're predicting future inflation and therefore setting future interest rate policy. This is the Phillips curve here. It basically shows the relationship between unemployment and the inflation rate. So as you can see, when unemployment is low, we would expect there to be a higher inflation rate and vice versa. So the theory is that when unemployment is low, that means it's more difficult for firms to find the right workers. Therefore, they have to attract new workers by offering higher wages. Those higher wages will feed through to prices and therefore we get inflation. However, there has been some speculation over the last few years that perhaps the Phillips curve has broken down. So this has been quite a hot topic of conversation among central bankers over the last few months. So let's have a look at some real data. We're looking at the US, and the reason we're doing that rather than the UK is that the weakness of sterling in the UK has impacted the inflation rate over here. So we think it's easier to look at the US data. So here we have US unemployment over the last 10 years. As you can see, the unemployment rate did spike quite notably following the financial crisis, but since then it has declined very steadily, and at the moment it is just above 4%. So that's considered to be a very low level of unemployment. However, if we were to rely on the Phillips curve, that would suggest that inflation would be on the way. However, as yet we're not seeing very strong signs of inflation, and that's why some people are saying perhaps the Phillips curve has broken down. So let's have a look at the inflation data. This chart here shows core inflation in the US over the last 10 years. Core inflation is just the regular inflation rate, but with energy and food prices stripped out. And that's done because those two things are seen to be quite volatile. So the core inflation number is what most economists tend to focus on. As you can see, the core inflation level has been fairly consistent around the 2% level over the last 5 years. So as yet, we're not really seeing very strong signs of inflation. And actually, the goal of most central bankers is to keep inflation around about the 2% level. If it goes higher than that, perhaps they would consider raising interest rates in order to get that inflation back down to target. So at the moment, as I say, not seeing huge amounts of inflation. If we go back to the Phillips curve, the theory there is that inflation would be caused by wage increases. And that's why central bankers at the moment are focusing quite heavily on wage growth in the US. And there, actually, we are starting to see some very small signs of growth. So have a look at this chart here. This shows annual wage growth in the US over the last 10 years. And as you can see, over the last couple of years, so 2016 to 2017, we have seen a very, very small amount of growth. So if the Phillips curve is still valid, this will feed through to inflation, and then to get that inflation back down to target, it's likely that interest rates will go up, perhaps more quickly than the market is currently expecting. When inflation rates go up and when interest rates go up, that tends to be bad for investments that pay a fixed rate of income. And therefore, perhaps the fact that people are now expecting higher interest rates is the reason why the US government bond price has recently come down to its lowest level since 2014. So at the moment, we're very closely watching investments that pay a fixed rate of income. We tend to find that investments with a very long maturity date are more sensitive to rises in inflation or interest rates and even expectations of high inflation and higher interest rates. And so at the moment we are watching very closely long-dated bonds. We're also watching other fixed income securities such as preference shares and permanent interest-bearing shares. We're also watching bond proxies. So these are equities that have bond-like characteristics. For example, equities that have good rates of income but not much expected growth. For example, utilities and tobacco stocks. So these can sometimes behave like bonds. So we're watching those very closely at the moment. And if you do hold any of these types of securities, we would encourage you to get in contact with your investment manager to discuss these. Also this week we have seen continued weakness in the dollar. If you have a look at this chart here, you can see the US trade-weighted dollar over the last 10 years. The trade-weighted dollar just compares the rate of the US dollar to a number of other major trading currencies, so it's a good general way of looking at each currency. As you can see, throughout 2017 and onwards into 2018, the dollar has continued to weaken. There are a couple of reasons for that. One is perhaps a bit of concern over Donald Trump. And the other is not so much that the dollar is weakening, it's more that other trading currencies are strengthening around the dollar and making it appear relatively weak. So for example, the euro has strengthened a lot this year, and that's making the dollar appear relatively weak. And actually the relative weakness of the dollar is not necessarily a bad thing for the US economy. It will make their exports look more attractive. And also it could potentially be a good thing for commodities that trade in dollars, for example, oil and also other mining commodities. But it's a very important trend to watch, and we will be keeping a close eye on it over the coming weeks and months. Also this week on Monday, we have seen the collapse of Carillion, which is a major construction and outsourcing firm. As you can see by the share price chart here, Carillion shares were trading round about the £3.50 level for many years until 2017, when there was a major profit warning, as you can see by the chart. And then on Monday this week, the shares were suspended from the market at 14 pence, and it's very unlikely that shareholders will get anything back. This has caused a bit of a concern in the market, particularly around other companies that operate in the same sector as Carillion. So we have seen a bit of share price weakness there. Also this week, a company called Lang O'Rourke, which is the largest private construction company in the UK, they've actually delayed the publishing of their latest set of accounts by 1 month. So again, that has caused some concern for investors in the sector, and we are watching very closely. Also this week, on a related note, the National Audit Office, which is a government department, they've released some very negative comments on something called PFI, which is the Private Finance Initiative. And that's the mechanism that governments use to transfer major projects from the public to the private sector. For example, this is how a number of major construction and infrastructure projects are financed. So because of these negative comments this week from the National Audit Office, we have seen weakness in some funds that invest in infrastructure projects that use PFI. So again, that is something that we are watching very closely. Moving on to the week ahead, as I said, things are starting to get a bit more busy now. It is the fourth quarter reporting season, so we do have a number of companies reporting next week. In particular, we're watching out for Johnson & Johnson, the healthcare company. We're also watching out for Antofagasta, the copper mining firm, as well as Diageo, the drinks giant, Union Pacific, and also Starbucks. So that's it from us. Have a great weekend, and we'll see you next Friday.